Hello, welcome back to the show. So in today's video, I'll be covering stocks that are up massively, as well as stocks that are down massively year to date. So for reference, this is my entire portfolio. I update this weekly. And in today's video, I'll be actually covering one of my larger holdings in the entire portfolio, which is UnitedHealth. I currently have around 5.6% in this stock, and it has slightly gone up after this big day for UnitedHealth. So for UnitedHealth today, the stock is up around 8%. It is currently trading at a 15 times of earnings. And for UnitedHealth, I am currently now finally in the green for this stock. At one point, I was down around 40% on my holding, and currently it's up around 10% or so after this big rise in the stock price. So for UnitedHealth, the reason why the stock is up so big is because they reaffirmed their EPS guidance this year. And besides that, UnitedHealth told investors that it expects 78% of Medicare to be 4 stars and above in terms of the CMS ratings. So this is positive for the company because it assures that the company will be able to bring in positive cash flows next year, possibly upwards of $15 to $20 billion, and this will likely pave the way for UnitedHealth's recovery. So for UnitedHealth as well as the entire insurance industry, the entire healthcare insurance industry has been down massively for the past 6 months or so, and historically the healthcare industry has never underperformed the S&P 500 to such a great extent. The only time that it did so was in the dot-com bubble, and currently we're at a similar level, so we're seeing some form of recovery in this segment. So for your healthcare insurance companies, the thesis for the companies is extremely simple. It's just an increase in prices next year. So this is an article by the Financial Times. It says, Americans face biggest increase in healthcare insurance costs in 15 years. Rising premiums add to pressure on households already feeling the pinch from the high price of goods. So what this article is anticipating is an increase in your premiums for all these different healthcare insurance. And if you're to look at what all these healthcare insurance companies are demanding, they're demanding double-digit increase in terms of prices next year to cover the margin pressures that they're facing this year. So for UnitedHealth, the thesis is an extremely simple one. It's just an increase in prices next year to improve margins. And besides that, Warren Buffett buying the stock makes the fraud case unlikely, and sentiments have changed since then. I think UnitedHealth is still undervalued today. It is still the highest quality company in the insurance portion. So for UnitedHealth, I'm sticking by this company. The next stock that I'll be covering today as well is ASML. ASML is finally above $800 a share again. It is my second largest holding in my entire portfolio, and it is currently trading at a 27 times of earnings. So for ASML, the worry of the company are as follows. First one is your China worry. So China is advancing in terms of EUV lithography, and besides that, the lack of complexity advancements could also be a worry for ASML. So ASML machines are so great that when volume increases for all these different chip demands, ASML won't benefit as much because they will just use the existing ASML machines. So they only do well when complexity of the chips increases. So if your little intensity increases, then ASML will benefit to a greater extent. So this is a possible headwind for ASML as well, relative to all the other semiconductor companies, because ASML is not the direct beneficiary of AI. Besides that, supply chain is a big problem for ASML as well, and ASML will likely be impacted if any tariffs were to be imposed on any of its working counterparts. So for ASML, despite that, I think the company is finally re-rating. It is one of the highest quality companies out there, and it clearly deserves the premium. So the 2030 guidance is still unchanged, and base case you'll get around an 11% revenue growth here on out, and that will be around a mid-teens earnings growth from here to 2030. So it's more than reasonable at this price. I think for ASML, it deserves a 30 times of earnings thereabout. I think the company is one of the high quality ones out there, and it's hard to find a business that is better in terms of quality than ASML. Of course, it's impossible to predict when the China risk will come, but for now, it is one of the highest quality businesses that you can own in the entire semiconductor industry. The next company that I'll be covering as well is one that has been falling. So this company is Chipotle. Chipotle is down around 35% year to date, currently trading at a 35 times of earnings. So for Chipotle, Brian Niccol has done everything already. So Brian Niccol has raised prices, he's introduced online orders, he's done drive-thrus, he's basically improved every single portion of the business already. And that is the problem with Chipotle because they don't have the latent pricing power already. So So they've hiked their prices on their food so much that currently it is hard for them to increase prices even more because it will hurt their volumes. So the company could, however, become interesting if the company expands more internationally or if the company chooses to embark on a franchise business model. So your franchise business models, they're typically a lot better because it improves the margin profile for the business. I mean, if you're to look at McDonald's, for example, McDonald's margins are currently at around 50%, the operating margin. So we could expect Chipotle to have something similar as well if they move to a franchise business model. But of course, under Brian Niccol, he refused that. He preferred for the stores to be company owned so that they could be standardized, so that the consumer experience is a lot better. But for Chipotle, for it to continue maintaining this ability of growth, I think the franchise business model is something that the company could pursue. And if the company pursues that portion, then this stock could get very interesting. But of course, Chipotle is currently still expensive relative to its peers. So it is currently still trading at a 35 times of earnings. And if you're to compare it to McDonald's, to Yum Brands, to Texas Roadhouse as well, the company is currently still trading at a premium. So the question to ask yourself is this: is international expansion worth the premium? And for me, I don't think that's worth the premium. So for Chipotle as well as their long-term targets, they're planning to have around 7,000 stores in the US as well as Canada in the near future. They currently have around 3,800 stores. So for Chipotle as well as all your different other restaurant companies, the main metrics that you need to look out for are number one, the store count, and the second one will be your same-store sales. So your same-store sales measures the quality of the revenue, and if your same-store sales is declining, that means that the quality of the locations aren't as good, or maybe the company is suffering from some kind of cannibalization, which is what we're seeing for companies in China, particularly Chagee or Mixue. So for Chipotle specifically, if you're to double the store count, double the revenue, double the net income, that gives you around 17 times of earnings today. And for 17 times forward earnings, we don't know when this stock count will come to fruition. It is still an expensive stock that I would avoid. So for Chipotle, although it is now around 35% year to date, this is a stock that I would avoid. The next company that I'll be covering as well is one that isn't really talked about. This company is one that I'm researching. So this company is called Honeywell. It is currently trading at a 24 times of earnings. So for Honeywell, they're currently a conglomerate. So they own a lot of different business models. They own your aerospace business model. They own companies in the automation portion. They own companies in materials. And they own companies in your building segment. So for Honeywell, I'm sure you're asking this question right now. What is so good about this company? So the Honeywell thesis and the Honeywell catalyst lies in the company's ability to basically break up into individual companies. So I'm sure you know Chris Hohn's investment in GE. GE was one of his greatest investments of all time. He bought into the company after the company spun off. So GE previously had three different departments. They have the energy portion, they had the healthcare portion, as well as the aerospace portion. So they split the company into three different companies. And so far, the company has seen rapid re-rating. So GE was previously trading at a 20 times of earnings, and currently the aerospace portion is trading at a 40 times of earnings. So just multiple expansion alone has accounted for 100% returns. So the thesis for Honeywell is similar as well. The company is planning to break up all its individual segments into individual companies, and the aerospace portion is one that is particularly intriguing because the aerospace portion has recurring revenues, similar to Safran, similar to GE, and they currently have around 65% of their market share in the specific market that they own. So for Honeywell, this is a company that I'm interested in. If the company splits off into individual companies, we could see rapid re-rating and massive returns if the company goes back up to fair value relative to its peers. Last portion, I'll be covering some questions left in the comments. So the first one, it says, how do you think about Copart's terminal risk? For me, I cannot predict what the business will be in 10 years. So for Copart, a few portions that I would like to highlight. So first of all is that AVs account for 10% of the cars in the US right now. So even if every single person, every single buyer in the US buys AVs, so 100% of the population that buys cars buys AVs instead of your normal cars, it will take 20 years for the entire fleet to be replaced by AVs. So that's one argument. Second argument is that Copart is venturing into other countries outside of the US. So they currently have upwards of 30% of their cars sold to countries outside of the US. So that portion is a foothold for Copart as well. For example, they have 50% market share in the UK, So if they're able to diversify that business outside of the US, and with the other countries not being as advanced as the US in terms of EVs, then that portion could extend the lifetime of the company. Lastly, the company is also extending its business lines into heavy machineries, into used cars, and so on. So I'm sure they'll figure something out in the next 10 years. Parts management team has been incredible. The CEO Jeff Liao worked in the company since he was young. So he was initially in the company he was working under the co-founder, which is Willis Johnson, and then he came back after starting. So I'm sure he knows the ins and outs of the business for him to make the right decision in regards to this. The next comment, it says, Salesforce is a company that you should look into. It's actually undervalued and its forward PEs are around 20 times. So first of all is that your forward PE ratio, they are non-GAAP. So if you're to adjust for the GAAP EPS, it is probably around 30 times for Salesforce. Secondly, for Salesforce, I dislike their CEO. So Mark Benioff, although he built the company from ground zero, he's a serial entrepreneur. I don't really like his actions when it comes to capital allocation. So Salesforce does a lot of acquisitions, a lot of inorganic growth, which is a portion that I don't understand. And the business line is also another portion that I don't completely understand. So for Salesforce, it's a company that I would avoid. The company is growing much slower than it historically has, so deteriorating fundamentals and poor capital allocation will probably deter me away from this company. So for now, I'll be staying out of this one. I hope you guys have found this one useful and invest safe.